Listen up. Valuations in venture capital are broken and everybody knows it. Founders sit across the table grinding blood, sweat, and sleepless nights into something real, while investors throw around numbers that often don't reflect a damn thing except hype or fear. You get screwed on terms that kill your upside, or your pitch gets laughed off because your startup doesn't fit some outdated mold. That frustration, it's everywhere. Investors, they're starving for better signals but stuck in the same old game, drowning in spreadsheets that almost never tell the full story. Everyone's trapped. Founders, investors, the whole ecosystem. And nobody's doing much about it because this broken system feels like the rules of the game you can't change. But what if valuations weren't fixed? What if they could flex, move, and respond in real time to actual progress, market reaction, and shifting potential? Not the nonsense annual spreadsheet filled out just to please accountants and VCs, but a living valuation that beats the market pulse. Dynamic valuations. This isn't some pipe dream, it's a total reset. No more selling yourself short. No more forcing a fake best guess once a year while your startup changes every damn day. Imagine valuations that breathe with your startup's heartbeat, where investors don't just fund risk based on historic numbers, but real-time signals that reward real achievement and adaptability. Look, the old way punishes founders for pivoting. It cages investors into bets that become outdated the second the deck is passed around. This kills innovation, kills agility, and kills trust. It's slow, cold, and rigid. Meanwhile, your business is living, breathing, growing, or dying every minute. Why base billions on outdated snapshots? Because we say so? Because the system hasn't caught up? You don't have to accept that anymore. Here's what you do. Stop chasing static valuations that belong in the last decade. Start pushing for dynamic scorecards tied to clear KPIs that matter. Revenue growth, customer engagement, retention, real market feedback, all updating on the fly. Demand transparency on how these numbers shift and why. Create or back tools that track these metrics publicly in simple dashboards, so no one's hiding behind smoke and mirrors. If you are a founder, don't let investors peg your company based on last quarter's guesswork. Force them to value progress, not projections. If you're an investor, lean into rapid data, not slow reports. Pressure your deal teams to build models that change weekly, not yearly. And here's the kicker. Dynamic valuations tear down the hierarchy that favors legacy names with old networks and let real merit rise. It rewards those who actually move the needle. So stop giving away equity to paper valuations. Stop sitting passively as your company gets stamped with an outdated label that undervalues what you bring. Instead, step up and demand agility. Demand alignment. This is how venture capital gets fixed. Not by wishful thinking, but by forcing reinvention through value that changes with reality, not some spreadsheet from 6 months ago. Founders, be ruthless about this. Investors, be relentless. If you don't, your competition will. This isn't just about money, it's about who controls the rules in the next decade of innovation. So, get angry about the lies you've been sold on valuations that don't move with you. Convert that anger into action. Champion transparency in your deals. Build systems, tools, and mindsets that adapt constantly, not snapshots that die the moment you close the round. You want to shape the future of venture capital? Start here. Demand dynamic valuations. Fight for it, implement it, live it. That's the only way to unlock real growth and fairness in a broken system. The old game is over. The players who embrace this will not only survive but dominate. Don't be left behind acting like valuations are some sacred mystery. Make them what they should be. Fluid, fair, and fiercely tied to reality. Now go make it happen. Subscribe to our YouTube channel and open the featured link to learn more.